From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for September 8th, 2023. Looking at the calendars, this weekend the Brewers are in New York with the Yankees. The Marlins and the Nationals are in Milwaukee next week. And Festa Italiana is happening this weekend at Milwaukee's Italian Community Center. A Florida man was arrested by the U.S. Coast Guard after attempting to cross the Atlantic Ocean in a giant inflatable hamster wheel. Now, you might think that was a once-in-a-lifetime trip, but this is at least the third time he's met the Coast Guard this way. A South African airline flight had to make an unscheduled landing when a highly venomous cobra was found under the pilot's seat. So I guess Samuel L. Jackson isn't the only one tired of these monkey-fighting snakes on these Monday through Friday planes. A man in Georgia took the name Porch Pirate a bit too literally. Not satisfied with petty theft of Amazon packages, he allegedly went to his neighboring property and stole an entire porch that was not attached to a home at the time. It may have had an abandoned look, but was not up for grabs, the porch's owner said. Finally, have you ever dreamed of running a race while dressed as your favorite Jurassic era creature? Yeah, me too. And we're not alone. More than 200 people headed to Auburn, Washington, all dressed in their best inflatable T-Rex costumes to run the track at Emerald Downs for the annual T-Rex World Championships. That sounds like a roaring good time. At the big table today, but sadly not in T-Rex costumes, I've got Art Rothschild, Mike Hoelzl, Joel Dresang, and looking back at the week, here's Kyle Tetting.
Well, thanks, Jason. And sadly, the T-Rex costume comes with a fan that might be a bit distracting while we're presenting for the podcast today. A tough week overall. A short week, but a tough week overall. The NASDAQ down 1.9%, closing at 13,762. The S&P 500 down 58 points. That's 1.3%, closing at 44.57. And the Dow Jones Industrial Average held up just a little better, but still down 261 points for the week, despite a positive Friday to close the week down 0.7% at 34,577 for the year. NASDAQ still up a stellar 32.2%. The S&P up 17.3%. And the Dow Jones, nothing to shake a stick at, still up 5.7% for the year, including dividends. You know, maybe, Art, a place to start is investors, I think, continued nervousness, entering a time of year in which things don't always go our way. Having been on a pretty significant run for a while, no shortage of things to point to that should be positives, and yet a tough week, even with some positive economic news.
Yeah, but as you're alluding to, this should be expected. Stocks don't go straight up. They go down every once in a while. I found it interesting that the losses this week were sort of the way they should have been. The NASDAQ, which is up the most, went down the most. The S&P, which is kind of in the middle, up 17% for the year after this week, lost 1%. Of course, the NASDAQ lost more like 2%. And the Dow, which is only up 5.7%, which is still a decent number, only lost 0.7%. So as far as losses go, this was relatively small. As far as the news goes, as I'm sure Joel will get into later with respect to the economic statistics, it's like it was a great week for good news, and again, the market took it badly, but not that badly. So this is the time of year in which, as you're aware, you've mentioned it on the show, September's the worst month statistically for investors. Okay, so we lose a few bucks. Everybody's afraid of October. Halloween's coming up. You have to watch out for losses in that month. There's always something to be concerned about. But when you're up 32% on the NASDAQ or driving right down the middle of the fairway, 17% on the S&P, I'm pretty happy.
Yeah, I'd say it's difficult to be upset, even giving back a little this week. And, you know, there's a lot to be said about seasonality in markets. Most of it is true when you talk about long-term averages, but completely irrelevant when you talk about the market we're currently in. And you mentioned the economic data, Joel. We had a number of releases, even on a short week, still a few things to point to that show that and this is probably me repeating myself again, but the economy is more or less on good standing, if not growing as fast as maybe we'd hope.
That's right. Yeah. I mean, you can keep repeating that because it hasn't changed. We've got some good news mostly, but some enough news in there that should give the Fed some pause as to whether, they're done raising rates. So we had factory order numbers, and those were down for the first time in 5 months, and showing that we're not really growing that much in manufacturing so far this year. We also had numbers from the service sector, which is the bigger part of the economy, and that's the highest rating for the ISM services index that we've had in 6 months, and that's been going 8 months strong. And another number this week was the trade gap, and that's a number that bounces around for various reasons, but that widened in July, and that's a bad thing for how the gross domestic product is measured. So the wider the trade gap, the bigger the trade deficit, the more that detracts from economic growth. But within that, there were some numbers that showed we were actually narrower than we were from the year before. And other things, every week we talk about the initial claims for unemployment. Those are pretty steady. Those are 38% below the long-term average. That's a very constant sign that employers are reluctant to let go of workers, which is a strength in the economy right now. And then we had productivity numbers, which those all sorts of things you can read out of there. There were pluses and minuses. We saw that the annual rate of hours worked declined for the first time in 3 years. But we also saw that if you measure from a year-to-year basis, that productivity, that output per hour worked, actually rose for the first time since the end of 2021.
And for me, the mixed economic news really tells me two things. It tells me, one, to your point, gives the Fed pause. It gives the Fed pause to pause, right? It gives them this idea that, maybe rates can stay here a little while longer than what the market thought initially. We were talking, at least from a market prognostication perspective, right? What are the futures markets saying is going to happen with interest rates? We were talking about a Fed that might be cutting into the end of this year or early next year. The market has started to shift on that to the idea that, all right, maybe rates will actually stay where they are. I think that's some of the response this week is certainly that the economy has been strong enough but not so strong that the Fed is starting to realize maybe we've found the sweet spot. And it's allowed rates a little bit further out to come a little bit higher. It's allowed, I think, investors to start to now make plans for, if this is where we are, that might not be the end of the world. And most importantly, the second piece of this, it tells us that the economy is strong enough to support rates that are higher than what we've seen in quite a while.
The big economic report that I didn't mention was the Beige Book, which is, anecdotal evidence that the Fed collects to inform their decisions on policymaking, and that showed actually that we've got this strong growth in the economy, but that the job growth is subdued. Was one of the results of the Beige Book. Price growth is slowing, so again that's good because that means that inflation is in check. Although that slower growth is decelerating. So, and then there was also, they pointed out that this was interesting, that we may be in the last stage of pent-up tourism and leisure spending. So, you think of COVID and the pandemic and how people couldn't travel about the country or the world as much as they had hoped. And so we saw a splurge of that, especially in the last year. And the Fed, from the evidence they collected, they think that maybe that's coming to an end, and so the growth that we have been seeing in the economy, the economic strength, may be slowing, which fits in with what the Fed's been trying to do.
Yeah, how fitting. I stare out at the Milwaukee River, and there's a Viking cruise ship sitting right on the river letting passengers enjoy Milwaukee. Maybe not the area I'd have them first enter the city, coming onto Jones Island next to the Milorganite plant. But, I think it's fitting to be able to look at that and go, well, every customer I'm talking to, every client I'm having a conversation with is talking about how they didn't travel for a little while. They finally got that big trip they were putting off under their belt. And now they're looking, but they're not looking with as much urgency as they had in the past. They're excited to be able to get back out there, but it's not, all right, I got to get that trip on the books. It's, all right, well, let's start to figure out now what we want to do next. And so to that point, maybe it's back to that more moderate growth that we have come to count on as the thing that drives the economy going forward, not the no-go to everything's all at once, but hey, okay, let's see a little more.
The revenge travel that they were calling.
Revenge travel, absolutely. Speaking of revenge, Mike, maybe a good time to bring you in.
I don't know how I feel about that.
One of the things I think that has been a part of the sell-off this week and in prior weeks in which we saw some pretty meaningful sell-off is a conversation on valuations. It's tended to be that the things that have gotten more expensive are the things that have sold off the most. Art pointed out this week it was the NASDAQ down 1.9 compared to kind of the more middle-of-the-road S&P down 1.3. I think it speaks to a broader conversation you and I have been having about how some of the conversation around stretched valuations, the idea that the forward price-to-earnings multiple on the S&P 500 is a little higher than it has been on average over the long term. Some of that conversation is maybe buried in the fact that it isn't everything that looks expensive.
Yeah, it's anytime you turn on the TV or anything and you see a conversation about valuations or you read an article or something, they always talk about how the stock market is, like you said, overstretched with valuations, how everything is expensive. Or stocks are expensive, I should say. Well, that's not necessarily true, right? If you strip out the top 10 stocks of the S&P 500, the average valuation of the rest is 17.6. The historical average is 15.7. So yeah, it's high or higher, but it's not as high as it could because the top 10, their current average is over 27.5, right? And then if you go even farther, like kind of narrow that down even more, if you strip out the top 6 of like the mega cap tech stocks that have driven the market the first 6 months, and you look at Apple's at 28 times, Microsoft 31, Amazon 48, Nvidia 35, Meta 23, and Google 24. You strip those out, yeah, stocks in the S&P 500, their valuations, they're not cheap, but they're not overly expensive, which shows that they may have some more room to run.
And of course, I think the challenge is in identifying value, right? And figuring out, are we willing to pay 22, 24, 28 times earnings for Google because we think that they can earn it? Or would I rather buy something cheap? And there's plenty of cheap stuff out there. The challenge is always in identifying, okay, why is it cheap? And a great example is China. China's trading at a pretty reasonable valuation, and yet news this week that maybe China's holding some American companies hostage again. Yeah, they can compete, and I know you've got some thoughts on that, but also, there's reasons for concern there.
Yeah, I wouldn't even stick my toe into China's water right now. It's they've got significant problems. They had real estate problems a few years ago that were threatening. They're threatening again. The latest thing this week, and it caused Apple shares to decline fairly significantly this week, is that they're going to ban government employees from using Apple phones. Well, we did the same thing sort of to them with Huawei, one of their companies, by banning, their equipment sales over here. So payback is something else. The other thing that is happening is that Tesla over there is getting competition from a major Chinese electric car manufacturer that's starting to export some pretty good cars at good prices around the world. So China's future perhaps is bright, but it's a little dull right now. So yeah, you don't want to be caught in the China trap. I still think stocks in this country, even though expensive, they're expensive for a reason. And the reason is we're consistent here, at least in terms of capitalism. And these price earnings multiples we're talking about right now are against the backdrop of high interest rates. If we can assume that interest rates are going to go down eventually over time when the Fed's done reining in inflation, then maybe those price earnings multiples, especially if earnings continue to grow, aren't going to look so bad if we're still growing over here. So I'm cautiously optimistic about the United States as a place to invest. And value stocks, because they haven't gone up as much this year, are just downright cheap. You're only looking at, as we said, year to date on the Dow, representative of 20-something% of the market, as you've been identified. It's up less than 6%, which is kind of what we expect to do, over long periods of time with a well-designed portfolio. So making a little more with the S&P, making a little more with the NASDAQ, a little less with the Dow over time. I think we'll do just fine.
Yeah, you take more risk, you should expect more return. I think this year is maybe a zoom into that and maybe a bit of an over example of what we should be seeing in terms of that conversation. But, I think clearly as we look at it, in particular the China part of the conversation, a note from a Dallas Fed economist earlier this year that pointed out that I think in large part a result of the trade war that's been going on with China, the role that China's played as kind of historically our major trading partner has taken a backseat now to Mexico, that there's a larger portion of exported and imported goods with Mexico as a percentage of the total than there is with China now. They've taken China's place as our biggest trade partner. And even then, I think we continue to find ways to replace parts of what we used to get from China. Didn't ever really send a lot to China, but certainly what we get from China with suppliers in other areas. And so Mexico is a great example. Canada represents about 12% of our import-export trade. I think realistically, that's one more reason why that outlook for China looks a little murky is, your buyer of last resort, the person that bought all that cheap labor and all those cheap goods, they're not shopping as much anymore from you because they found some other store to go to. And so I think as we look ahead, I'm pretty optimistic about the U.S. I'm pretty optimistic about North America in general because the trade patterns have shifted to more regional trade, and that supports what we're doing here. I think the reminder for everyone right now, we've got a seminar coming up pretty soon here. If you haven't already signed up, I'd encourage you to hop on our website, check it out, send an email over to Lisa, send an email over to your advisor and let them know, hey, I'd like to attend. Most importantly, got a little bit of space left, but we'd love to see you out there. And a good opportunity for us to dive a little deeper into some of these topics, maybe give you a little more visual on some of the supporting evidence, because it's a good opportunity to educate, and that's what we're here for. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.